Hey, it just means that you have a risk management plan. So if the trade goes south, what are you doing? If it's losing 5%, are you trading out? 7%, are you trading out? At 10%, are you trading out? What's happening? And where do you think it's going to go, and where are you taking profit? Most traders will go for a 3-to-1 risk to reward ratio. So bear that in mind. And most traders will only risk 10% of their trade capital on each trade, maximum. Let me show you. You could have rules per trade, like I'm only going to take 10% risk on each trade. So for a £1,000 trade or $1,000 trade, I'm only going to lose £100 because that's where my stop loss is going to be. And I'll only enter if X, Y, Z conditions are met. For example, RSI is X, volume is X, or the price is between X range. That way you still have $900 left to continue to trade. So your entire portfolio should have similar rules. For example, you should have rules as to how much is your maximum limit per trade. So for example, the average portfolio size is about $5,000. But for the sake of this example, I'm going to use 10,000 because it's a nice round number and people understand it better. So for a $10,000 trading account, you want to split up the capital so you're not staking a large amount of capital in one trade and therefore risking a lot more. You might set it up so you have 10 subsequent trades from 10,000. So $1,000 each, 10 times, 10 trades. You don't have to commit to all of it, obviously. In this case, I've got 5 trades on the go at £1,000 each, giving me a balance of 5,000 in liquidity. The entire purpose of this is that A, you don't chase your losses and therefore lose more money than you should. And B, you lose money very slowly so you can learn. And once you learn, hopefully you will be making less trading mistakes. Also managing your exposure to risks. So if a trade goes south because of something, something happens in the market, an oil tanker explodes or something like that, then your exposure to that particular trade or that particular decision is limited to a defined bit of capital. So my exposure to oil in one trade should be limited to $1,000. This way, your entire trading strategy and your portfolio should be extremely controlled. You can then review your behaviors to see if you're making wrong decisions based on the way that you'd commit due diligence. But it should never be because you've done the wrong thing in terms of process. Well, eventually.